So from there, we get the sum of all these discounted cash flows, and that produces our net present value here. And the last piece is to strip out any debt from that valuation and add any marketable securities and cash that the company has. So that would be anything that is directly liquid and they could deploy in an instant or in the short term if they needed to. And so adding those all together, we get the value of the business here. And currently it is showing at an $891 billion valuation, which is pretty phenomenal given the fact that today's market cap is at $158 billion. So that is essentially implying that the company is undervalued. Now, a couple caveats and things you want to keep in mind is, again, the faster the growth rate, the more that you're going to see these free cash flows expand at a faster clip. That's not a bad thing, but you always want to be a bit skeptical and cautious whenever a company is growing super fast, because it's just difficult to know how long they'll be able to sustain it and what is their long-term average. So we try to mitigate that to some extent here, but ultimately, and from that, we're seeing that the company is undervalued. One way or another, it is well below 50% of what we think the company is worth. And so that is a good margin of safety to start with. And then from there, you're going to want to do the next steps of diving in.